So we've been talking about the weakness in China's economy. Wall Street was pumping it up last year. Finally, they're starting to, throw in the cards, and they realize it's not going to be anywhere near like they thought. And even now, they're saying they don't even think there's going to be a stimulus. I don't agree with that. Once again, this is an aggressive play. It's an aggressive entry, an aggressive position. But I do believe there will be a stimulus, and I think by the end of the year, we're looking at 32, 33. I did mention last time, well, let's go ahead and I guess kind of before we go into FXI, last time, of course, we talked about the deflation that's going on in China, and the deflation is because of the real estate bubble. Those of you who got the China report, you understand what's going on. That real estate problem is a huge issue. That's why you're seeing the disinflation with the consumer inflation data and the deflation with the producer price data. You don't have spending in China because people don't have money. It's a huge problem. The real estate issue in China is a house of cards. It is collapsing, and the problem is it's not just real estate. The government is deeply involved in real estate. There's obviously no improvement you can see. This is because consumers just don't have money. This is a deflationary environment. It's not officially deflationary yet. It's disinflation, but I think it's safe to say they're probably headed there, especially if you take a look at the leading indicator, which is the producer price index. Right now, this data is not new. This is you can see minus 4.6%. And then now FXI, we'll show the chart here in a minute. We talked last time, and I went ahead and added this, and I put it in bold because this is something from the webinar. This was not in the original notes, but it was in the webinar. A little more detail, and that was to, generally speaking, you want to buy on weakness and sell on strength. And as you can see, actually, I mean, it's holding up pretty well, it's holding up a lot better than it should, given what's going on in China. I would think this thing is headed back down. This should be down, 3,000, testing the 3,000, and maybe down below that, I would say. So I think it's holding up much better than one would imagine. So FXI, June 9th was the last data point, Friday. This was Monday. So I mentioned, you may want to look to sell, put a sell limit order. There you go. It pops a little over 27.82. It pops about 1.5 points. So if you were following my guidance, you may have gotten out like I did. Okay, I haven't gotten back in. It's gone as low as, looks like, 26.50. I haven't gotten back in, even though it might pop over the next few days a little more. I'm not interested. I'm going to wait until this thing hits mid-20s, and it may not. If it doesn't, who cares? I don't want it. Okay, that's kind of the way I see it in terms of a risk standpoint. You can see this 6-month chart, a modest bear trend. India. So you can see the new data point here for inflation. It keeps going down lower. It's great, but at some point we don't want it to go too low, right? Because you're going to have to lower interest rates, and we don't want to do that prematurely, right? We don't want to start lowering interest rates too soon. All these countries want to be somewhat in sync with the Fed. Why? Well, you all remember what happened last year. About this time last year, you had all these rate hikes, and the dollar soared. The dollar soared last year. Why? Because the Fed wasn't doing a good job informing investors, consumers, what it will be doing. Remember, they were very, very conservative about their interest rate hikes, and they gradually continued higher and higher and higher. But before you knew it, they caught everybody by surprise around the world. The point is that some countries are going to be faced with pressure to lower rates. I already talked about Vietnam is pressure to lower rates. They've been lowering rates now, and finally, they of course they manipulate the currency. They've held it steady. It's finally starting to move. It's finally starting to weaken against the dollar because they have a problem in their real estate market. There's a problem in their banking system. Not as much as in China, but a little bit. You know, they have a lot of speculation in Asia, and so they're trying to lower rates because they want, you know, a lot of people are in trouble and they need to refinance and pay debts, borrow money. So you don't want to lower rates too much before the Fed, because you're going to cause capital to flow out of those countries, and that's going to cause a problem for the economy. You see, that's why we're watching these things, because I want to make sure, you know, you would think that it's a good situation for India, right? Because India, of course, we were always on the watch for high inflation. That's a killer for India. Big risk. Inflation is great now. Let's not get into the situation where we're with China, more of a deflationary situation. You don't want that. It's going to cause rates to come down. You don't want that. Not right now. I don't think it's going to happen in India, at least not to the extent in China. The Indian economy is doing relatively well. You can see the rates are at 6.5%. They've held there for the past few months. And so last time we talked about holding, if you got into the low 15s, you mentioned you might want to take some profits, but overall recommendation was to hold. And you can see how, you know, IFN rallied all the way up to 1660 before retracing, and that retracement, of course, coincided with the recent weakness in the market, in the U.S. markets. And so we recommend continuing to hold IFN. Of course, a continuing decline in inflation, which is very good, but we talked about also Brazil is starting to face potentially some pressure on their, you know, low inflation, whereby they may start to need to lower rates. Of course, they've got rates at just under 14%. They have a lot of room to lower rates and stimulate the economy. So we've been talking about past couple of months, I don't know, maybe 3 months, EWZ being a good play, much better play than China. For just holding it, you know, 33, 35, collect the dividends, you know, and you can get out after that, right? Now, if you did sell it, I think you should wait for under 30 for reentries, okay? It's not going to hurt you, you know. I don't recommend necessarily getting into it now. Now, remember, a lot of these slides I just keep there for context, right? To give you some perspective so that you don't have to pull up a bunch of old sessions, you know, and dig through that. More review. And of course, we were talking about this several months ago, the inflation target, right? That was the big discussion. And, you know, look, folks, if you go back and you remember all these things that were important, the market doesn't care. They don't care. The market doesn't care, okay? It's pushing past everything, right? Just keep that in mind. We want to see something come out that causes the market to sell off. That's a buying opportunity. And this is just review. Just remember about the shelter costs that's driving inflation. That's driving the core and headline inflation. And of course, shelter costs is being driven by the strong labor market, right? And this is a new chart for rent inflation. You can see it's come down a little bit from last time. It was 8.1% last time. So for the first time over the past 15 months, finally, the BLS number, the non-farm payroll number came in lower than the consensus. Remember, for 14 consecutive months, the jobs data has beat the consensus estimates. To me, this is not enough progress. So this is the latest, and I think we're getting one next week. University of Michigan Consumer Sentiment. I think it's on the 18th. The new data, the preliminary report. But you can see a nice pop. A nice pop. We're getting looks like a rebound since the banking crisis a few months ago in March. Manufacturing PMI, this is not updated, but it's still about this level. It's still in the contraction mode. This is just another review chart. Doesn't have the updated. This should be 2% here. All the other GDP data are correct. You can see this is just a review, but we show here the technical recession in 2023 is probably it's unlikely now. It's unlikely. I mean, if we're going to get one, and I say technical, of course, you all know 2 consecutive quarters of negative GDP growth. We got that in the first 2 quarters of last year already. This is not an updated chart of the Treasury yield, but just to refresh your memory from last time, we were showing a recovery from that sell-off in the yield. In other words, investors were buying up treasuries, right? Forcing the yield down. And now they're selling treasuries as the market's recovering. Right, let's go ahead and show you an updated chart. So you can see it popped past this recent period here. Now it's finally getting into a healthier territory as the market has strengthened, as rates continue to go up higher. And, you know, I mean, the 10-year yield should be obviously a lot higher. No change. It's actually getting a little worse, right? You can see that. Just comparison from the 80s. So now we've surpassed a 1-year period where we haven't even had any type of flattening of the curve at all, where it's come back up to 0 or above. I would say probably, you know, we might start to see that by the fall. So the July estimates, Q2 consensus now is minus 7.2%, and Q3 is 0.3%. So we're already in an earnings recession. The question is, are we going to get out in Q3? Does it really matter? No, it doesn't, because we're going to be out by Q4. P ratio, the forward P ratio, the S&P is 19, and you know we're getting back up to these, you know, these higher levels, but that's okay if things are going to get better. You know, the longer we go without a problem in the banking system, the greater the chance it's over. So you can see as a review, these are the original targets that were forecast more than a year ago. And once again, the low number is the worst case scenario. High number is the best case scenario, right? Or kind of like, let's say you could attribute that to maybe mild recession. Best case scenario, basically. We've reached all these targets, except for, I guess, if you want to consider the 28,661 low in the Dow, not having reached this. You know, if you want to, you know, you can see the lows here. So the Dow, you can see October 13th, that was the low in the market. Ever since that time, it's been very strong, especially this year, and especially the NASDAQ this year, right? So, I mean, this is out of the picture. I don't see full recession. Now, come back to me in 2 or 3 years, maybe it's a different story, as I've been talking about. But, you know, I think the worst is over for now. S&P, right? If God intervenes, that's my quote there for the 3,600, and we actually got a 3,492, which I listed the mild recession at a 3,400, 4,650 to 4,800 over the next 8 to 10 months, and I would say, you know, cut it in the middle, so you can call it, you know, 4,750, 4,750. Okay. So this is the Dow on the 9th, last data point. You can see, I mean, you know, as soon as the report was released, the market popped. And the Dow has since come down lower. Now we've got longer term support resistance at 33,000, 34.8, 34.7, 6 month, right? 9 month, 1 year. So you can see that upper resistance is around 34. I mean, it could be, you know, it could be lower too. Be a little lower, you know, 34.6. You know, shorter term is going to be 34.5. Longer term is going to extend this. It's going to raise it a little bit. Let's take a look. The 3 year. Yeah. So yeah, you can go a little lower. Let's call it 34.5. 3-year. Let's go to the 9-month. So you can see, right? It's selling off. You see that? S&P 1 year. Let's go to let's go ahead and show you the the 3-year. So you can see 36, 38, 42, 44, 4,600. I'm just showing this for purposes of potentially looking for retracements, breakdowns of when to get in the market, right? That's what we want to look for. This is obviously the market is very bullish. On the other hand, it's due for a nice sell-off, a correction of at least 5%. Okay, it would be nice to get that, right? So with that, let's go ahead now and fly through this topic. Will the U.S. lose its reserve currency status? For those who came in later, let me just go ahead and remind everyone else as well. This is a topic I'm going to cover quickly. I wanted to make sure and cover it in case I don't produce a standalone video presentation. I might do that.
There are two fundamental reforms that we need is to get adequate capital and two, to get far higher levels of enforcement of fraud statutes. Existing ones, I'm not even talking about new things were being done which were certainly illegal and clearly criminal in certain cases, which, I mean, fraud is a fact. Fraud creates very considerable instability in competitive markets. If you cannot trust your counterparties, it won't work. And indeed, we saw that it didn't.
So things went very well, and then the economy collapses. And so all of a sudden people are saying, well, it was Alan Greenspan's fault because he should have anticipated this. Did you think that was fair?
Nobody forecast the 2008 crisis. One of the things I put in the second book I wrote was how the IMF missed it, the Federal Reserve missed it. You go down a whole series of the major forecasting.
Well, everybody got it wrong, let's say.
You can't have a crisis of that nature that is not a surprise. Nobody forecast the 2008 crisis. One of the things I put in the second book I wrote was how the IMF missed it, the Federal Reserve missed it. You go down a whole series of the major forecasting.
Well, everybody got it wrong, let's say.
You can't have a crisis of that nature that is not a surprise. Nobody forecast the 2008 crisis. Nobody forecast the 2008 crisis. Nobody forecast the 2008 crisis. There are two fundamental reforms that we need is to get adequate capital and two, to get far higher levels of enforcement of fraud statutes. Existing ones, I'm not even talking about new. Things were being done which were certainly illegal and clearly criminal in certain cases, which, I mean, fraud is a fact. Fraud creates very considerable instability in competitive markets. If you cannot trust your counterparties, it won't work. And indeed, we saw that it didn't. Certainly illegal and clearly criminal in certain cases, which, I mean, fraud is a fact. Fraud creates very considerable instability in competitive markets. If you cannot trust your counterparties, it won't work. And indeed, we saw that it didn't. Certainly illegal and clearly criminal in certain cases, which, I mean, fraud is a fact. Fraud creates very considerable instability in competitive markets. If you cannot trust your counterparties, it won't work. And indeed, we saw that it didn't. There are two fundamental reforms that we need is to get adequate capital and two, to get far higher levels of enforcement of fraud statutes. Existing ones, I'm not even talking about new. Things were being done which were certainly illegal and clearly criminal in certain cases, which, I mean, fraud is a fact. Fraud creates very considerable instability in competitive markets. If you cannot trust your counterparties, it won't work. And indeed, we saw that it didn't. Nobody forecast the 2008 crisis. Things were being done which were certainly illegal and clearly criminal in certain cases, which nobody forecast the 2008 crisis. 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 Nobody forecast the 2008 crisis.
terms of getting back as an investor, if it's coming down to here, almost irrespective of what's going on, I have to believe. If I have to make a call in advance, and of course I can change depending on what happens, but I have to believe this is where you want to start doing that 18, 17, around there. Their earnings report is a complete game changer, at least for quite a while. Bottom line, NVIDIA now is going to enter the realm of Tesla, Apple, and all these other big, I mean, listen, NVIDIA can come down to 150, come down to $100. If you don't think it's possible, then you don't understand how the market works. I mean, listen, NVIDIA can come down to 150, come down to $100. If you don't think it's possible, then you don't understand how the market works.